Hi, and welcome to Sanford Advisors Software and Internet Monthly Report for March 2023. As usual, we are going to review the previous month's M&A and venture capital activity across the entire technology landscape. So let's start on the M&A front. At a high level, we saw $5.7 billion in disclosed transaction value for a median revenue multiple of 6.7 times, albeit across a relatively smaller amount of volume with only 72 transactions for the month. As we will expand upon further in later slides, the overall M&A markets are still healthy, but we're seeing a lot more focus on strategy, cash flow, and synergies. The acquisition of Evo by Global Payments is a good example. Evo offered international expansion for Global Payments while still strengthening its core markets. And at a 6.7 times revenue multiple, it's reflective of a new norm that we're seeing across strategic value in the current tech M&A landscape. As we finish up Q1, we continue to see that the year is lagging behind the pandemic surge in activity and is now forecasted to be below even the 2020 levels in terms of dollars invested in numbers of transactions. With uncertain macro variables and the recent crises in the banking sector, buyers are remaining cautious. This is evident in both the deal volume, dollars, and transactions, and as we'll see on the next slide, in terms of valuations as well. As we now have a full quarter of data for 2023, we can see that the median valuation for software and SaaS transactions has continued to decline. Where we saw a short-term correction in value to start the year, the last 2 months have seen the median decline again, and somewhat more telling, we have seen the spread between the top and bottom quartiles continue to compress. This compression is almost entirely driven by the reduction in the values of the top 75th percentile. On the surface, this indicates that buyers' caution is not just leading to more passes or less volume, but also a curbed risk appetite to take high-value bets in the current uncertain markets. Another interesting point we can see through the spread of SaaS multiples and non-SaaS multiples. Typically, the higher recurring nature of SaaS revenue has garnered a premium valuation. And while this is proving to still be correct, the spread between the two has significantly contracted. Non-SaaS companies tend to have slightly shorter break-even points and better cash flow, and we continue to see greater emphasis placed on profitability versus growth. Therefore, we're starting to see the valuations for these two types of revenue streams continue to compress. As mentioned earlier, the overall deal volume has continued to decline since this short correction to start the year. March recorded the lowest deal volume over the last 24 months. We will likely continue to see a reduced level of volume as greater emphasis is placed on risk reduction, cash flow, and strategic fit. Switching gears to the venture capital side of things now, we see a pretty big jump in overall dollars invested for the month of March at $9.7 billion. However, the vast majority of this was driven by the large $6.5 billion raise from Stripe, which was a non-growth oriented investment round at a 3.5 times valuation. If you exclude Stripe, the beleaguered nature of the VC market continues to be evident. Dollars invested were relatively flat month over month, and transaction volume continued to decline, as we'll see further in the next slide. Moving to the monthly VC deal counts, as mentioned, the overall transaction volume has hit another 24-month low for the month of March, with declines across all stages of investments. Capital allocation continues to be risk-averse in this market, and we will likely see additional contraction in the VC market for the next few months. This is further reflected as we look at the annualized data through March, which implies over a 45% decline in deal volume and over 30% decline in dollars invested for the year, which would be worse if we remove Stripe. It will likely take a material shift in the macros before we see the VC market return to even pre-pandemic activity. Now, one interesting trend we saw through the end of the first quarter was the return of valuations for early stage investments. This should be an early barometer of a recovery, but given how compressed this segment was for the previous 2 months, early stage being inverted to mid and even late stage in January, it is likely some outlier investments in March, and we could see this correct itself next quarter. And with that, we conclude this month's review of the software and internet M&A and VC market update. As always, thanks for listening, and we hope to see you next month.